The market today was down really big and then was able to rally itself back. At some points today, it really kind of felt like the wheels were coming off the wagon. And I think that the reason the bears had a hard time with follow-through was that the market had already been down really heavily overnight. It had been short. Often there's an inventory rebalance, and that was not the case. I think a lot of people, just based on the levels that were getting hit and based on just the sheer point declines I was seeing in some of the stocks, a lot of people I think got washed out. Their stops were run, and people who had been shorting, who were doing it during the regular trading hours, had poor trade location, and it didn't take a lot to kind of get the market back up. There are some positive things that happened today, and there are some fairly negative things that happened today. Let's start off with the positive, since we're happy-go-lucky people here, right? So the positive point is that we held an important line, a range low, really, that I had drawn in at 205.38. We violated it by about 2 ticks. If you guys are not following my levels at this point and think it's all just guesswork, you better guess again, because they're working out pretty well. So we violated that by 2 cents and then proceeded to just completely rip higher. A couple of things so that's the good part. The bad part is where we closed. We closed at 208.92, and that's just below the 208.97 kind of other distribution that we needed to really get into. We filled the gap, which was good. I kind of had discussed that when we were coming back up, that I thought the gap was going to get filled. The breath was turning. I had said to watch Apple, that I thought Apple was the key, and I had discussed on the stream the 109s being the right or right out play up to 115s, which wound up playing out. I had also started mentioning, and I started this yesterday, saying that the rate of change in the oils, particularly Exxon and Chevron, which are huge Dow components, as well as S&P components, the rate of change, that's what the TV people always miss. They always miss the rate of change. They'll always start out with the exact, the macro amount, the point decline, or the fact that something is going up or they're going down, but they don't talk about the rate of change, which is just the amount of up or down in that time period. Now, Exxon has been down a lot. I have been saying that there are some key levels in Exxon. I wasn't planning on starting with Exxon, but I will, because I made a very prominent comment on the stream with it today. So Exxon now has what I would consider a quote-unquote secure low in, meaning it shouldn't go back to where that low of the 76.33. And the reason I say that it's quote-unquote a secure low is because that's a lower low, and it's bookended on 2 ends by higher lows, meaning the day before the low was higher, and today's high was higher. It was actually even still higher than the prior day. I believe the close was, let's see, 78.79. Close was 78.75. Yeah, perfect. So that should be a secure low now. So I think you can play any pullback, like any weakness. If there's some early weakness in Exxon, like use 78 maybe as your stop. Exxon should have a little bit more gas in the tank. If it loses it, we're going to see 74.59, which is a 61.8 fib, and I'd be an interested buyer or put seller down there for right or right action. I don't know if we're going to necessarily get down there. It's kind of back to like the breakdown point, one breakdown point here. So I would be a little bit cautious with the size if you didn't kind of catch it low today, but I do think that there's some move back up. Now, I said on the stream something that I think a lot of people might think is arbitrary, but I think is true. If Exxon is below 83, I think that the risk of deflation and a recession is very real. If we can get back above there and start challenging the 86s again, then I would say that we're probably seeing some type of a turn in world demand for oil. You probably will have a bottom in oil, and you'll probably start seeing some bottoming action in the U.S. as well as potentially in China. if Exxon stays weak, I'm kind of using that as a global proxy, particularly for oil. When things kind of hit the fan, that is one of the most rock-solid balance sheets in the world. If their stock can't rally, you've got problems. So that is my thesis on Exxon. I don't want to get into too much nuance other than just the price, but believe me, there's some method behind my madness. I don't want to put you guys to sleep with my thinking on that, but let's keep it simple, stupid here. 83.01 was the gap fill. It needs to get back up there. It needs to clear there. If not, I'd say that the market is still vulnerable to still lower. Let's segue that into oil. I'm sort of probably wagging the dog here. So today's low in oil was slightly higher, but there was really not much of a rally. Although I guess not being down is the new up, right, with oil? So 42.41 is the key low. We may have a double bottom here in place. Let's see. Really, to confirm that, you really need to get back up over yesterday's high of 45.34, and then I think there could be some rally, maybe even into the low 50s. So we could discuss that when that bridge crosses. It's bombed out on the stochastics. It's the sentiment is just terrible on the street. I think a lot of the news that came yesterday and today about the Chinese devaluing the yuan, their currency, was the sort of the why, and that was the reason why this weakness has taken place. If you look at a lot, and as well for Apple, if you look at the growth areas that the world, one of the engines of growth in the world that has been a commodity consumer, has been a product consumer, has been Apple. Has been China, China and India. Let's go back a few years ago. Brazil, Russia, China, and India, BRIC. That was what everyone cited, all the TV talking heads cited as the growth engine for the world. All four of those engines are now flamed out. Brazil is on the verge of depression, particularly with commodities out. They also have a very socialist former guerrilla president, that Ms. Rousseff. She is a disaster. Russia, we all know what's going on with Vladimir Putin. The guy is like on the rampage trying to put together back the old Soviet Union. India has been stumbling. Their economy is not doing well. I would say that out of all of the BRIC, they're maybe kind of one of the more concernings, just because you don't hear about it in the news as much, so people aren't aware. But their prices, they are still within a range. If you look at the EPI, that's that Wisdom Tree ETF, but it is well below trend. It's below the channel. It's weak. China, we all know, their economy is a disaster. They may have a bubble with regard to housing. Their stock market is in crash mode. They're trying to do a sort of a switch from industrial to consumer economy. We know that things are not well. Alibaba, I will discuss that right after this, was a complete debacle, that IPO. Things are not well. So all four engines of global growth are out. So what we also know that the European periphery is blowing up. We know that the economies in Germany are slowing. We know everything around the world, GDPs around the world, including the United States, are slowing. So a lot of you have heard me discuss the lower for longer thesis, and I've discussed that the unemployment rate here is artificially low because so many people have dropped out of the employment picture. They've been been unemployed so long they no longer count. The durable goods orders were crap. The only the only component of that was good was Boeing, and now with the Chinese devaluation, that's going to hurt our companies like Caterpillar even more. They can't compete with the Japanese like Komatsu. The labor participation rate, the amount of percentage of Americans working, is the lowest since 1978. That is not good. And there were GDP revisions of the last 3 years lower. And now with the Chinese currency lowering, the GDP in the U.S., the reason why stocks like Apple are in free fall and dropping are because all of their earnings estimates now have to be revised lower. The end market that they're selling into, China, they're going to make less money on this. I think a year or so ago, this was kind of what was happening with Russia when their currency was in free fall. China is devaluing. There's really not, I don't really hear much with regard to the administration talking to do anything about this. It's a real problem. And I think that Apple did what it should have done. It tested the 109s. It stopped just short of a complete gap fill, but I would say close enough for government work. And it got back up into the 115 resistances. If Apple is below that 119.75, let's just say 120, the risk is still lower. I don't want to get anyone too crazy, and I know everyone, I wouldn't say everyone, but there are a lot of people who are of this philosophy of own Apple, don't trade it. I think you learned your lesson. If not, you might still have a lesson to learn. If that 109 fails, Apple could easily see back to the 100.72, potentially like 101-ish. That's really the primary trend line. That's really the primary trend line. I do believe that around that 100 area will be an amazing opportunity for right or right out if this fails. The bad news is if that fails, you can see 95s and, believe it or not, even 85s. That would be the big 61.8% retracement of the entire move in Apple. It broke down a few days ago. It rallied back up 2 days ago. It retouched those 119s. And then it absolutely got sleazammed down lower. It got the 109. This is all just technical trading here. But the issue, and the stochastics are a bit bombed out on the daily, so it wouldn't shock me to see that Apple kind of try to like chop and hold. But I do believe, unless it can reclaim those 119s, I do believe that it's making lower highs and lower lows. And until that pattern shifts, the stock is going to go lower. I like their products. I'm recording this on an iPhone. I'm a big Apple fanboy, but I'm not a big fan of of the price action in the stock. I do believe that there'll be it would be good if the stock kind of washed out and got out all of these weak hand chasers who think they should just I don't want to get too into pointing fingers, but it would be it would be good if it washes out. In September there's the new iPhone launch. I believe that will be a catalyst for the stock to go higher. So let's see what happens with that. It could mark some time with sideways with more time than price, but the stock is looking rather weak. I think also what's been weighing a little bit on Apple is Google. Google decided to break. First of all, they had a great earnings report. There's really no knocks on that report. I looked through it. It looked good. I think the problem with Google was that it had run up into the earnings $50, rallied another 100, and then it pulled back, and now they're breaking up into this Alphabet, which they're going to house their internet brands are, and they're going to kind of break out the Moonbase or whatever, into a separate company. So yeah, September 7th. There we go. That's the iPhone announcement. So I think that will be a catalyst for higher in Apple. So if you're long, you don't want to see it below 115s. Below 115s, vulnerable. Anyway, sorry to get sidetracked. Someone had mentioned the date, so I just wanted to say that. So I think a lot of money has been shifting from Apple into Google and also into Facebook. Speaking of Facebook, the main issue that has been plaguing Facebook was that it ran really hard on Google ahead of their own numbers. They used up a lot of their rally, and it's been doing fairly typical price action of pulling back. The 50-day moving average to me would be it kind of almost filled the gap. It's been kind of just chopping lower. It's still below. If you drew a regression line from the highs, it's still below that. I don't even have it drawn in. I'm just eyeballing it. You ever notice that with people? They can't eyeball it. You should be able to eyeball it. If you do this and you're good at what you do, you should be able to eyeball the chart and know what you're looking at. Anyway, so just by eyeballing it, we're still below the regression line. I would start getting interested in kind of BTD. First is on 89.05, which is the the 50-day moving average, I would start getting a little bit excited between there and like 88.02, which is the 50% Fibonacci retracement from the recent run. I would be looking to sell 85 to 83 strike puts, anywhere in there. Those are also some fib lines. The 61.8 is 85.37. Any type of move down into there, I'd be starting to look to, like I said, start putting on a big boy position with regard to selling puts or even buying some shares again. So between that, in that zone. Yeah, a lot of people have a lot of opinions on Facebook, but I think I've been the one who's been right. So I'm going to stick to my levels until they're proven wrong. Let me take a look at this. All right, if we're going to talk Facebook, let's go into Twitter. Why not? So Twitter is starting to look like it's trying to bottom a little bit. I was saying that the 26s were the IPO area. First of all, I had said on Twitter that it was sort of a one-way train. It was a binary trade, either to 45 or to 29, and it wound up being to 29, and it wound up even being more. Twitter is still vulnerable as long as it's below 28.50. Not 28.51. What am I talking about? 29.51. We're still below there, so it's a little bit. I would say a little bit vulnerable still, but I do believe at some point this stock will have some type of a rally attempt at the very least. I don't know how successful it would be. They have a big problem on their hands. They still have a growth valuation. The company is still worth like close to $20 billion or whatever, and I don't know how many companies you know who are going to line up to shell out $20 billion for a company with no user growth. Not me. I think that they are going to have to prove it, and they're going to have to prove their valuation. I know they're doing some changes to their service. I guess they're going to try and become a messaging app now since they took away the 140-character constraint on their direct messages. I think the problem for Twitter is that they just need to explain their product or build something that the masses can use. Most people, what really broke MySpace and what tilted it toward Facebook was that Facebook had unlimited photo sharing at the time, and MySpace had a minimum. And I think that's what really broke MySpace. I think what Twitter really needs to do is not become more Facebook-like. They need to become more Instagram-like. I think that would do really well for their service. And I mean, they made a deal. They inked a deal with the NFL. Now we just need to see them ink a deal with FIFA, MLB, and NBA. I think that would be great for Twitter. They need to start being the kind of news. All the news breaks on Twitter. Everyone has conversations on Twitter. I mean, the GOP debate was this week. Everyone was talking on Twitter. You know, they just need to figure out how to monetize this, and I just think that they're kind of trying to be something they're not. Their management is terrible. So, sorry to beat up on Twitter, but the stock, believe it or not, could be cut in half again, and it would still be expensive. So, they need to prove it. So, if you're playing long, you don't want to see it below this reversal day here. I would say 27.82. Anything below there starts getting real iffy to me. All right, so that's that. I covered Exxon. I covered Apple. Let's discuss Alibaba for a minute. How's that? Alibaba. So I played this stock multiple times. I've made some money, I've lost some money. In the end, it's been really more of a headache, I think, than it's been worth. I think the problem that people are having with that stock is that obviously we know about the Chinese problems, but with regard to your risk management, I think a lot of people were kind of holding on and hoping that the stock was going to go higher today. And call it that, or just experience, or just risk management. At a certain point with any stock, you know, everyone's always afraid they're going to miss the rebound, right? The stock has come down, they've been sitting in it for a long time, and they're going to miss the rebound. You know, you have to respect price, and I had said that 80 was the stop on this, and if you got below 80, you needed to be GTFO, and for those of you who are new to my stream, GTFO means get the F out. as in the opposite of that is RORO, which is the write or write out. Anyway, the money management and my, I guess, trade discipline is sort of what saved me in there. And once it broke, I was out. And today, the pattern played out. It wound up having the gap lower. It wound up rallying, though. It's still below the lows. If you look at the EEM, which is also the kind of the emerging markets, that broke a really key level. I think that was what also had me cautious on this BABA. It's always an amalgam. It's an experience for me of everything. And it's tried to gap lower the last 2 days, and that has been, they've had hammers the last couple of days. So I'm curious to see how this goes, if it can get back above, if this is like a false breakdown or if it's a real breakdown. As of now, you have to think it's real just because it's lower, although it's been in a very begrudging fashion. So just keep your eye on that EEM if you're looking to play these, like, these, I don't know. You know what? Let's just call it what it is. These third world stocks. That's what it is. You want to run your economy like a third world, you're going to be called a third world. I will say this though. In all of this Chinese malaise, I think that we will look back on yesterday as the day where China started having more relevance with regard to monetary policy than the Fed. I haven't believed that the Fed was going to raise interest rates. I've been saying that for the various economic reasons I mentioned earlier, I don't want to go back through the litany, that they were going to be on hold with raising interest rates, and they were just talking tough because they want people to believe that rates are going higher. It's sort of their attempt at moral suasion. If you don't know what that is, Google it. It was something the Fed really attempted in the late 1920s. It didn't work then. It's not going to work now. I believe that the Chinese move with regard to their currency is now going to hamper the Fed even further because of the dollar strength. I discussed about all the international companies needing to lower their earnings estimates, which will be a knock on GDP. And if you look at the dollar, it should be strengthening with what China did, but it's weakened, and it closed slightly below the 50-day moving average, although it is still in dangerous striking distance of breaking out. This could be a shakeout before the breakout, but the good news is we're now starting to make some lower lows. If that happens, the dollar has a long ways to fall to the down channel, possibly even 91s. But that's another discussion. Anyway, I believe that the Chinese sort of said, we're in charge here, and the Fed is now not going to be able to raise interest rates. Just my opinion. We will see. We will come September. There's a lot of people saying, oh, the Fed is going to do it just to do it. If they do that, then they should be, committed for incompetence, because they shouldn't let TV talking heads who just need to fill up space and time bluster on about what the Fed should and shouldn't do. If they're truly data dependent, I hate to keep banging this drum, but they shouldn't be raising interest rates. And, with regard to these TV talking heads and these TV traders who've probably lost people more money than I can count, a lot of these guys can't even trade their way out of a paper bag, nonetheless should be on TV giving advice. Just follow the levels, just tune that junk out, put on Pandora, find a good station. I can make some recommendations if people want to know, but just tune that garbage out. It's going to lose you more money than you can imagine. With regard to trade discipline, because I've been preaching this endlessly, if you haven't seen my 10 risk management commandments, I really want people to check it out. Take a look at a chart of Sun Edison, S-U-N-E. I just want you to look at this chart and think about this when you're thinking about adding to losing positions. Same thing with BABA. Take a look. Imagine all the people who averaged down the whole way down. The stock is at a new all-time low today. Anyone who's ever bought BABA, unless if you bought it on the dead lows today, are absolutely wrong and underwater. I don't add to these positions. I know that the TV people and the books, all the books, they say buy on the way down, add to positions, average down. This is insanity. if you are averaging a position down, there's no one to say that the stock is going to go back higher. And for me, it's not opinions or theories that matter, it's money. And if you are not in a winning position on a trade, don't you dare buy another share. Only average up when you're shown to be right. Let me tell you, that will save you so much pain and so much effort. What happens when you buy a stock and then you add to it $10 down and then you add to it $10 lower and then $10 lower? You're underwater, and all you're doing is adding to your losses. It's almost, rather than bailing the water out of the boat, you're throwing the water into the boat to sink you faster. This is just insanity. Don't listen to this nonsense. Just do it the right way. There's a right way to trade. It's been documented by Jesse Livermore. If you haven't read Reminiscences of a Stock Operator or How to Trade in Stocks by Jesse Livermore, just get the books, read. I think that's the right way to trade. Adding and saying you're long term and all this works really well in a bull market, but when things turn, the same things that made you the money will bury you. The geometric series is asymmetric, and it will bury you on the downside. Look what happened in this Sun Edison. I like to use that chart. The Sun Edison chart is so ugly. This is like the kind of thing they show kids, like, to get them to brush their teeth when they don't want to brush their teeth. You show them like that mouthful of cavities or whatever to scare them to brush their teeth. If this thing won't scare you to not buy on the way down and to only buy on the way up, and to respect when there's a trend line break, when that trend broke in the 26s, 27s, that to me, if nothing will scare you into it, if this won't do it, nothing will. So I rest my piece on that. With regard to the Livermore book, Reminiscences of a Stock Operator, was written by Edwin Lefevre. The other book of How to Trade in Stocks is actually written by Livermore himself. They're both really good. The Reminiscences is my Bible. Like, if they always say, if you were stranded on a desert island, what book would you want? I would say Livermore this book would be it. I don't know. I guess I'd be just averaging my coconuts, right? How to trade in coconuts. But to me, that book, I read it at least once a year. I read it sometimes more than once a year. It is amazing. How to Trade in Stocks is sort of a bit of a summarized version. It's not as colorful. It's Livermore later in life. I think that you read both. Honestly, I think they're both great. I covered a lot of stuff here. There's a little bit more to cover. Let me see. I covered oil. I covered China. If you're in these stocks, if you're in these low, these dollar stocks, just the ones, or I would say these stocks that have benefited from weak oil. Oil could go lower, but I would say it's a good idea to take some profits. Like, if you've been in companies like Royal Caribbean Cruise Lines, how do you think their comparables are going to be next year if oil's $100? That stock is going to be destroyed. Just be careful. These have been huge winners. I never say to sell your winners, but it doesn't hurt to take profits and to use some stop losses. I would just be really careful, particularly with that stock. You have a bit of a shooting star, gravestone doji. Anything below 91.70 in that stock, be real careful. I know of a few of you who I really like, who follow me, who have been piling into that stock. Congratulations, you've done really well. But just be a little bit prudent and, just realize that they're going to deal with some tough comparables when oil does rebound. Same thing I could kind of say for like a Chipotle, right? They've been a big beneficiary of lower prices in oil. That has been a monster. I had said that the stock I thought would go higher. It's probably going to chop a little. This stock does periodically go through some convulsions where it's not liked as much as any. I would be sort of a more buy the dips than chase, particularly on this tape, but it's held up pretty well. As long as it's sort of over this 27.97, the stock probably can still go higher. Anything below there gets a little bit iffy. Just be careful. Just trying to look what else I want to discuss. Priceline. So Priceline did what I thought it would do. I had discussed I thought it would have the big gap. It's now filled the gap. I would say You can use the low of day today as your right or right out if you're playing Priceline. It gapped into old resistance up around that 1379. It actually traded higher. I think even in after hours it was at 1400. The high of the day that day was 1395. This company depends a lot on, increasingly so, on European business, believe it or not. Although I think a lot of it has been offset by the strong dollar has actually helped them. A lot of people are traveling to Europe. I was in last summer. I went to a friend's wedding in Capri. The euro was $1.40. This year it's $1.10. Man, do I wish that trip was this year. It would have been so much cheaper. But yeah, I would say today you have a little bit of a hammer. If you want, you could play a little bit of right or right out. I don't really love to screw around with Priceline too much. I'm more of an Expedia fan. I think that they have a better app and a better business, believe it or not, at this point. They have been playing some games with their pricing. They always come up, I think, as the cheapest because they show the pre-tax price, so they wind up coming in cheaper in the search engine. I think Priceline is still a great business. But, you know, $1,000-something stock is a little bit iffy to play. Expedia is coming off. That once in a while has some convulsions. You know, if you want to play a little bit of a safer play, Expedia. At some point, Priceline's going to split the stock, and it'll be a lot easier to deal with. You know, but a lot of people who have smaller accounts, you know, they can blow out really quickly in Priceline. Just be real careful with that stock. There was something else I had wanted to discuss with regard to the metals, gold in particular. So I was sort of looking for it to come back down to this 100.44 or potentially even 91.65 on like the full washout. But we're starting to do a bit of a rounded bottom turn. And I haven't been playing gold per se, but I have been playing in silver. And we had a bit of a false breakdown in silver. I had been playing it long against 1403. It wound up stopping me out at 14. But I got back in. I saw the way it was trading that it was like begrudgingly and couldn't stay below there. And I got back in the stock and with SLV, and it's ripped, and it's actually sort of into a bit of close to one of my resistances to take some profits up in the 15s. But I believe that these things are maybe starting to turn a little bit, as crazy as it sounds. So I would be looking to kind of play some buy the dips on this. If you can hold, like with SLV, you really needed to hold above 1434. Anything below there to me gets iffy. I had said I thought above 1458 was an ad. If you start getting below there, take off the ad. Simple as that. Excuse me. But the metals are showing some progress. They've been a debacle. You know, if the dollar really does start weakening, maybe these start getting some giddy up. Metals rallying, and I don't want to make this call yet because I don't know if I believe it just yet. But maybe there's QE4 coming. You know, the economy is starting to weaken. The dollar, it has been really strong. And global current markets around the world have weakened. I think one of the things that has dampened the global recovery, oddly enough, is the stubbornly high prices in energy, particularly in Europe and Asia. And now that they've come down, this might help their recovery some, but we are in a deflationary spiral, and the way to combat deflation is to print. So we'll see. Maybe there's going to be QE4. Maybe the metals are whiffing that out. Maybe they're going to finally get a little bit of a run. We'll see. Anyhow, I think I've covered a good amount. I'm just looking at some of the comments people are making. I think I covered mostly everything everyone wanted to talk about. Maybe we'll end on Tesla, right? Let's end on Tesla. So Tesla's back to the 50% fib. It actually had turned early today. It was one of the first to go green, although the rally was a little bit lackluster. 234 is a really key level. I'd start really being more comfortable buying this in the 221, somewhere between 221 and 205. I'll be interested in selling some puts there. That's the 61.8. We're currently at the 50%. I don't know if it's going to get that low. Maybe like somewhere between the 225 and 221 could be a good area for a right or right out. If you want to do it, maybe sell some near dated out of the money puts. I do believe there'll be some price memory down there. I do think at some point Tesla is going to go higher, but it needs oil to stabilize. Same thing with solar. These stocks are going to continue to get the stuffing knocked out of them until oil bottoms. Anyway, that's my story. I'm sticking to it. The lower for longer thesis lives. We may be making lower for life. The new statement, but we'll see. Anyhow, thank you guys so much for tuning in. If you tuned in late, you'll be able to, like I said, you'll be able to see the rest of this or the whole video on my YouTube channel, which is Justin Pulitzer Trades. Be sure to follow me on Twitter. The handle is @JustinPulitzer. There's a link to the YouTube channel in there. I do, believe it or not, tweet out some levels and some important market commentary that I believe will save you and make you money. Anyhow, I like that L for L. That's pretty good. I might have to use that. Anyhow, let's have a good weekend. I will be doing the weekend review video. Yankees, of course. Don't be ridiculous. So let's have a good weekend and get through the rest of the week. Actually, before we leave, I want to give some more important SPY levels. If we break today's low, we're going to see 204s and then 202s pretty quickly, I think. If we wind out taking up the high of the day, look out for the 50-day moving average and also the trend line. 210s are the key. That has been the resistance. If we can clear and hold 210s, believe it or not, the all-time highs will be in play. If we can't hold them, we're still in this weak, choppy range BS, and it's, anyone's guess. Today was a false breakdown, although, like I said, we are now starting to make lower lows off lower highs again. That is a dangerous pattern. Don't fall in love with your longs. Again, don't fall in love with your shorts either. Just trade the range. That's all that I'm saying. I keep saying this time and time again. Smaller positions, smaller swings, and shorter time frames. Just stick to that game plan. It's what's worked all year and what will probably work for the rest of the year. All right, with that said, hasta la vista, baby.